Hi, I'm John Strohmeyer with Strohmeyer Law. Today we're talking about 10 year-end ideas to help you save tax dollars for 2022. Now, with 2 months left to go in 2022, there's still time for you to think about and take action on these top 10 ideas to help you save some tax dollars. Not every one of these ideas is going to work for you. And always remember, talk to your actual advisors. Don't just take the advice of some talking head on the internet before you pull any triggers. Some of these things could go wrong for you and trigger some actual taxable gain for you instead of being tax-free. So let's get to that list. First item, don't forget you can take tax-free income on accumulated wealth inside of your Roth IRA. Now, there are requirements for this. If you are under 59 and a half, you're not going to be able to do this. Also, the money that is in that Roth, before you pull it out, it needs to have been in there for at least 5 years. So this is not for everybody. Remember that if you're able to take money out, you've got to be 59 and a half, and the money needs to have been in there for at least 5 years before you start pulling this out. But if you meet those categories, if you meet both of those options, then you can pull some money out. Also, you may be exempted from the RMD, or required minimum distribution rules, that affect traditional IRAs. If so, you might want to consider pulling the money out of that traditional IRA and leave the Roth IRA for your beneficiaries when you pass. Item number 2, tax-free IRA withdrawals on top of your tax-free Social Security. Now, between 50 and 100% of Social Security benefits can be tax-free for folks with more modest income. If that fits you, then you might also have some otherwise taxable withdrawals from your traditional IRA. Now, there is an option for you to shelter some of those withdrawals from federal income tax using your standard deduction. Now, in 2022, standard deductions are different for folks depending on what your tax status is. It's going to be $12,950 if you're a single person. It's going to be $19,400 if you qualify as head of household, and it'll be $25,900 if you are married and filing jointly. Now, if you're over 65 and as of the end of the year, then the standard deduction amounts are going to be a little bit higher. The point is, part of your Social Security benefits might be federal income tax free, and ditto for also the taxable withdrawals from your traditional IRA. Again, you've got to be able to fit it under that standard deduction, but you might be able to squeeze some income out of your traditional IRA. So take a look at that. Item number 3, tax-free gains from the sale of your house. Now, this is one of the best deals out there. Obviously, you're going to have to be able to sell and close on your house before year end for this to work. The good news is it's going to work next year too. What are we thinking about? Well, you can exempt up to $250,000 of taxable gain from capital gains tax. Now, this allows you to basically receive income for selling your house and then pay no tax on that gain. The thing to think about, this is taxable gain, so it's actually a better deal than you might think. It doesn't mean up to $250,000 in selling your house. It means if you paid $400,000 for your house and you sell it for $600,000, that gain of $200,000 is going to be exempt from tax. Now, there are a few restrictions and requirements on how long you've lived in the house. So it's not something you can just buy and flip, and you can't do this year after year after year. But for most folks, this is an option where you can liquidate an asset, go buy a new house that may be better for you and your situation, right sizing as they may call it, but it'll allow you to exempt that gain from income tax. If you're married, it actually gets doubled up to be up to $500,000 in gain. So a lot of money that you can receive as income. You're probably going to reinvest it in a house because you're going to need to live somewhere, but it's something that is available to you. And so you may want to think about it. While this may not be a year-end tactic, it's not something that's going to get phased out or go away anytime soon. Option number 4, tax-free capital gains and dividends. So capital gains and dividends, these are items where it's not traditional income that you're going to get on your W-2. So if you're in a particular sweet spot where the tax rate on long-term capital gains and qualified dividends is 0%, then great news. The surprising truth is you can have some pretty healthy income and still be in that 0% tax bracket for long-term gains and dividends. So, for instance, if you're married and filing jointly with two dependent kids in 2022, you can claim the 25,900 standard deduction. Then you can have up to $109,250 of adjusted gross income, AGI, including long-term gains and dividends, and still be in that 0% bracket. So I won't go through the numbers, but know that there may be some capital gains and dividends. You may think about, look at the numbers, talk to your tax advisor. You may want to squeeze out some extra money from your from your brokerage account somewhere else to help have some extra money for the holidays. Tax item number 5, capital gains that you can shelter with capital losses. So this is where if you've taken a capital loss earlier in the year, you may want to start harvesting some of those gains that you got somewhere else. Stock market did take a dip. You may have liquidated something, leaving a loss on your balance sheet. If so, you may want to look around the rest of your brokerage account, see if there's something that's got some gains. You may want to take those items as gains now, liquidate it, knowing that you're not going to have to pay tax on it if you have losses from earlier in the year. So this is, not a year-end thing, but it is looking at what you've got in your portfolio. Is there something you can use to offset? Because your losses are limited, you don't want to get in a position where you've just kind of left them out there. It's a tax attribute you want to make sure that you use. So again, if you've got the losses, make sure you set them off with some gains so that you're taking advantage of that tax attribute. Tax item number 6. This one is a little morbid, but remember that if you have inherited assets from someone, so if somebody has passed and left you something like a house or a brokerage account, when that person died, the basis for tax purposes stepped up or down to fair market value as of their date of death. So think about it this way. If your beloved Uncle Bill bought Exxon stock for $10 years ago, and then when he died last year, the stock was worth $100. Well, if he had sold that stock for $100 the day before he died, he would have paid tax on the taxable gain. That would be the difference between the 100 it was worth and the 10 that he paid. So tax on that 90. But the tax code says when he died, we're going to step the basis up from 10 all the way to 100 so that you're not going to pay tax on it. Now, this stems from when the estate tax credit used to be much lower, and you still would get effectively credit for paying estate tax on those assets. Now it's available to all of us anyway. What you get is that free run-up in basis for that appreciation that occurred during their life. So remember that if you've inherited assets, you've got a new basis as of the date of death. Best way to check on this, you may want to look if it's a brokerage account, something in the stock market, go pull a statement from the date of death. That's going to be the new basis. If you've got something that you inherited but isn't in a brokerage account, go look at the inventory for the probate estate. This would be something like a house that you may have inherited. Again, inheriting that means that the basis was reset as of the date of death. This could be some tax-free gains that you may not have realized you had. Tax-free income item number 7, a tax-free exchange under Section 1031 of the Internal Revenue Code. Now, 1031 allows folks to swap real estate primarily as a like-kind asset. If you've got plot A and you want to acquire plot B, you can just basically swap them in a taxable transaction for tax purposes. What this does is not so much tax-free income, but it does let you kick the tax bill down the road. So you'll get the new property. You just won't be treated as having sold the old property. You're going to keep that basis, whatever gain you would have paid tax on. We're kicking that can down the road until later when you sell that second property. Tax-free item number 8, tax-free gain on small business stock gains. So qualified small business corporations, or QSBCs, there are a special category of stock where you can potentially qualify for some federal income tax-free treatment when you sell that stock for a gain. Now, the way the law works, you've got to meet a bunch of different tests, but this may be something that if you've acquired this stock, or if the shares were issued after September 27, 2010, they are potentially eligible for 100% gain exclusion. This really then would mean if you can engineer a sale, doesn't necessarily have to be by year end, but something to keep in your back pocket. If you can qualify for this stock, it'll allow you to exclude any gain in that qualified small business corporation. Tax-free item number 9, using Section 529 plans for college savings. Now, these Section 529 plans allow earnings to accumulate free of income tax. It's similar in concept to an IRA. You put the money in the account, it grows tax-free. When you take it out for appropriate items, education, it's going to be tax-free on those gains. So it allows folks who can make bigger contributions to put the money in, let it grow, and then when they pull it out, that gain isn't being treated as taxable income. The other thing to think about when it comes to these 529 plans is that they're also going to help for your estate tax planning. You can use your annual exclusion gifts of currently $16,000. It's going to bump up to $17,000 in 2023. The money you put into those 529 accounts, it's going to reduce your taxable estate. You may also want to consider putting 5 years of these gifts in at once. The tax code currently allows you to put 5 years of annual exclusion gifts in a single year. Now, they're going to be rated out. You're not going to be able to make annual exclusion gifts to that person for the next 5 years, but you can put one big chunk in at once if you've got the extra money to be able to afford that. So it's something that we consider for our estate tax planning because we can move a big chunk of money out of the estate for folks. Tax-free item number 10, our last item, tax-free withdrawals from your Coverdell education savings accounts. Now, you can contribute up to $2,000 every year to a Coverdell education savings account set up for a beneficiary who has not yet reached age 18. The earnings on those are allowed to accumulate federal income tax-free. Then when you take tax-free withdrawals from those accounts, they can be used to pay for beneficiaries' college tuition, books, supplies, and room and board. It's similar to a 529 account. The overlap is not 100%, but it is in the same vein. Now, if you have several beneficiaries in mind, you can contribute up to $2,000 per year to separate Coverdell accounts that you set up for each person. That's all the tips we have for right now. There are a lot of options out here. Remember to talk to your advisors about any of these items before moving forward. As the talking head on the internet, I don't know your specific situation. You may qualify for this. You may just stir up a hornet's nest if you start pulling these triggers. Have a safe and tax-free end to your year. Thanks so much for watching. If you've got other questions about this, go ahead and leave a question in the comments below. Also, don't forget to like, comment, and subscribe.